This is SWBC's Uncharted Wealth podcast, episode number 23, where we're talking about the widow's penalty and how executing strategic Roth conversions can help you lower or eliminate your future tax burden. Hello and welcome to SWBC's Uncharted Wealth podcast, where we help you explore the financial landscape and help you navigate your journey to and through retirement with confidence and clarity. I'm Mike Walters. I am your host. I am a certified financial planner and a wealth advisor here at SWBC. And in today's episode, we are talking about Roth conversions. I know, again, but Roth conversions can help protect your spouse from future tax burdens. Nobody wants to pay more taxes than they have to. So we're going to explore how the shift from joint to single filing status is going to impact your taxes and why converting pre-tax assets now can be one of the most loving financial decisions you ever make. Now, this is called the widower or widow's penalty. Now, it's a terrible name, I understand, but why does it exist? Well, when one spouse passes away, the surviving spouse is going to move from typical married filing joint status to single in the year after their spouse passes away. So yes, you do get the year that they passed, you can still file as married filing joint. However, after that though, they have to go to a single or head of household status. Obviously eligibility for that still applies, but today's conversation, we're still just going to talk from married filing joint to single. And what that means is, number one, there's going to be a lower standard deduction. It's not really a penalty, but it just is what it is. Narrower tax brackets, okay? So if I don't have the tax brackets in front of me, but typically what you'll see is a married filing joint tax bracket is going to be a lot wider than what a single filer is going to pay on the same amount of income, okay? You're facing potential IRMA surcharges on your Medicare premiums because your income could potentially go up. And then you're potentially going to be paying higher taxes on that same income. Now, this can be especially painful for couples that have very large pre-tax accounts. These are your 401ks or your IRAs, and that are going to continue generating income through these required minimum distributions at some point. So now when you're looking at Roth conversions, timing is going to matter. Okay, so the best time to convert is going to be after retirement, but before RMDs begin. So let's say you retired at age 65. You have a good 10-year window before RMDs start at age 75. Now again, your RMD beginning age is going to be based on the year that you were born. So I will have my team put this up on the screen here, but for most of my clients right now, RMD age is 73, but if you do not turn 73 before 2030, your RMD age becomes 75. That's how the current IRS law is written. So that's what I'm using as the RMD age is going to be 75. So think about it. You retire at 65, you don't have to take RMDs until 75. That gives you a 10-year timeline where you can start doing Roth conversions, where you don't have your employment income and you don't have those RMDs stacking up on top. This is going to be even better, well, obviously, when both spouses are alive. And you're filing your taxes jointly because, again, you have those wider tax brackets, but even better if you can time this when you have these low income years. So let's hypothetically say that you've done a good job at saving and you have a very good liquidity layer set aside in cash. You can use that as your income for a couple years and thus keeping your income very low. Maybe you also delay your Social Security benefits, right? So keeping your income as low as possible, and you do those Roth conversions during those years. That way you're taking advantage of these lower tax brackets. But this is where the planning is going to get a little bit personal, okay? So you don't need to convert everything. And I honestly believe you should not convert everything, okay? But converting enough over a certain amount of time can make a big difference when you get to those later years in retirement, and RMDs can potentially stack up. So some other considerations is conversions are going to increase your taxable income in the year that you do them. Okay, that's the whole premise of it, is you pay the taxes now, so you don't have to pay the taxes later. So if you are already Medicare age and you're doing this, you have to be careful because those IRMAA surcharges are still applicable if you're doing Roth conversions at age 65 or later, okay? What you'd want to do is maybe spread out your conversions over multiple years. That way you can take advantage of the lower tax brackets in multiple years and stay within that target bracket. And then last but not least, I kind of already mentioned it, but you need to consider the impact on your Medicare premiums. Social Security taxation as well. You know, if you're not wanting to get your Social Security benefits taxed, then you also need to leave your taxable income lower. But these are all different considerations that you should be looking at when potentially doing Roth conversions. Now I'm going to take a moment here before we jump into the Uncharted section to remind you, like, comment, and subscribe to this channel. We can also appreciate if you want to comment on what topics you're interested in for future episodes. Okay, because I've had people, you know, stop me on the streets and say, hey, I wish you would talk to me about this, da-da-da-da-da. I'm like, well, I need you to like, comment, and subscribe, or I'm not going to take your opinion to heart. I'm just kidding. But yeah, let us know what you want to hear in future episodes. Also, our new Uncharted Wealth podcast website is up and running. So go down in the description and click the link so you can learn a little bit more about the podcast and yours truly. And while you're out there browsing the internet, you can also stop by our SWBC website. Go check us out at the Wealth Management Division. If you're interested in linking up with an advisor like myself, there's also a form you can fill out there. So do that. Now we can roll into the uncharted territory of today's episode. Uncharted territory for today is the tax-free legacy layer, okay? I know by this point you're probably like, Mikey, I think you're just making up things. And to be fair, no, I'm not making up things. I'm just creating very cool titles for some of these strategies that we already use. But so the tax-free legacy layer it's a nuanced strategy, okay, is to intentionally build a tax-free legacy layer, which is a portion of the portfolio specifically designed to support the surviving spouse with tax-free income. So it's just what we're talking about today, right? This layer can be used to offset the RMDs from these inherited pre-tax accounts. It can also be used to help maintain that surviving spouse's lifestyle without having to trigger these higher income taxes and potentially avoiding these IRMAA surcharges. Now, you can build this layer with Roth IRA assets. You can maybe take some of your taxable portfolio and invest it in municipal bonds, or maybe just using your cash reserves like I mentioned earlier. Last thing here is permanent life insurance. Obviously, we all know, or we should know, that life insurance proceeds get paid out tax-free. So if you have these huge pre-tax accounts and you just don't see yourself wanting to pay the taxes now versus later, then maybe, obviously, if you're healthy enough, you can look at doing some permanent life insurance so that way that benefit pays out tax-free and then you can offset those taxes later on. Now, the key takeaway for today's episode is that Roth conversions aren't just about your retirement. They're about your spouse's future too. So planning ahead while you're still both alive and filing jointly can significantly reduce the amount of taxes that your surviving spouse potentially pays with what we call the widow or widower's penalty, and protect the life that you've built together. So on that note, I would like to encourage all of our listeners and watchers today to review your pre-tax balances and the projected RMDs that might be coming later on, and potentially talk to an advisor about Roth conversion timing and survivor planning. Okay, it's not talked about enough, and I think it's very important in making decisions about doing Roth conversion. So consider how your tax strategy today is going to impact both your future and your surviving spouse's future. So if you're married and you're within 10 years of retirement, I would recommend that now is the time to plan for this. So you can visit our website in the description below if you want to schedule an appointment with myself or another advisor and want to make sure that you know we expect you to share this with everybody. Okay? Share it with your mother, brother, auntie, uncle, cousin, and hopefully somebody that you care about, so that way we can get the word out on the Uncharted Wealth podcast. As a reminder that nothing that I talk about today is to be taken as financial advice, legal advice, or tax advice, and any opinions that I share are mine alone, not anybody else that works at SWBC or SWBC itself. So I want to thank you for joining us today on the Uncharted Wealth podcast, and we will see you next time. Peace. That was great, guys. I'm Mike Walters, and I'm going to redo that section.
Perfect.
What?
They stop you in the streets.
They stop me in these streets.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.